To most of us, credit scoring is a mystery. Have you ever wondered, how's my credit score calculated? Welcome to Mortgage University, where we help educate you about the home buying process. I'm Brian May.
And I'm Jacob Miller with Stockton Mortgage. Today in our series, Understanding Credit, we'll take some of the mystery out of credit scoring. Your credit score is a number that summarizes your credit risk and tells a lender how likely you are to pay back a loan on time. Your credit score is important because with a higher credit score, you'll pay less for a home, car, and even insurance. Some employers won't hire you with a low credit score.
You actually have three credit scores from three separate credit bureaus: TransUnion, Equifax, and Experian. The credit scores range from 300 to 850, with each bureau using a similar but slightly different FICO scoring model. You may have heard of a FICO score, and you actually have three of them from each of the three bureaus. For home loans, lenders use your middle score.
So what's a good credit score? Subjectively, anything over a 740 is excellent and will allow you access to the best programs at the best rates. 700 to 739 is very good, 680 to 699 is good, 640 to 679 is fair, 620 to 639 is marginal, and under 620 is poor.
So what is on your credit report? Current and past credit accounts. Think mortgages, credit cards, auto loans, student loans, and other installment loans. Derogatory events like bankruptcies, collections, and charged-off accounts will also appear on your credit report and will negatively impact your credit score. When a lender pulls your credit, it's called a hard inquiry. Too many of these can affect your credit score. Now, the credit inquiry from a mortgage company generally has very little impact on your score.
It's also important to know what's not in your credit report. It doesn't include any profile information such as race, color, religion, natural origin, marital status, or age. Many bills you pay every month, like rent, utilities, and your cell phone, are also not reported in your credit report, so they don't impact your score. That is, unless they fall into collection. Some lenders don't report your payment history to the credit agencies. This is often true with buy here, pay here car dealers.
So how is your score determined? 35% of your credit score is based on your payment history. That makes sense. Have you paid your bills on time? Paying a bill more than 30 days late, collections, bankruptcies, and foreclosures are all score killers. 15% of your credit score is based on the length of your credit history. The longer you've proven you can borrow money and pay it back, the better your score. 10% of your score is based on a mix of credit in your credit history. An ideal credit report has a mix of credit cards, installment loans, and mortgage loans. 10% of your score is based on new credit. How many of your accounts have been opened recently? Opening a number of new accounts in a short period of time can be an increased credit risk.
Surprisingly, 30% of your credit score is determined by how much you owe in relation to the credit limit on credit cards and lines of credit. This is known as credit utilization. Having a high balance in relation to your credit limit can be a sign that you're overextended and spending above your means.
Now that you have a better understanding of what impacts your credit score, you'll be in a better position to manage your score. If you like what you've seen, make sure to hit the like button and subscribe to our channel. Be sure to check out the other videos in our Understanding Credit series. If you have any questions about any of the information presented here today, or want to get pre-approved for a home loan, please give me a call.